We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us. You can always find out more about Brian, Arrin, and the team by going to the website deckerretirementplanning.com, deckerretirementplanning.com. And every time we start the show, I always say you could go to that website, deckerretirementplanning.com, under the heading of Safer Retirement Education. There are 12 different things you can download, no cost to you. It's there for your information to download any or all, including Brian's book on retirement, The Decker Approach. That's one of the 12 things you could download right there on the website. Glad you're with us today. We're going to talk about year-end tax execution. Brian, there's a lot of things we got to do by the end of the year. And of course, if we wait till Christmas, which is on a Thursday, that means the next time the offices might be open would be the 29th. I'm thinking December 29th might be too late to get this stuff done.
Yeah, there's a lot of things here. We're going to spend the whole hour today talking about the year-end deadline, things that need to get done. And Arrin, let's start with required minimum distributions. Tell the audience what it is and why year-end, and especially how to do it right. There's a right and wrong way to take your required minimum distributions.
Mm-hmm. Yeah, so if you're unfamiliar with this, required minimum distributions, or RMDs for short, is essentially the point in time when the IRS says, look, you've had long enough to defer the taxes on those traditional IRA accounts, 401k accounts, and they start forcing you to take withdrawals out of those pre-tax accounts. And the distribution as a percentage that you have to pull out every year gets bigger as you get older. So they have changed the timing rules on this a couple of times in the last few years. It used to be that everybody had the start date for RMDs at age 70 and a half. Recently, they've changed it now where it's based off of the year in which you were born. So if your birth date is before 1960, then you start required minimum distributions in the year that you turn 73. If you are born 1960 or later, they have that RMD age at 75. So it's the year in which you turn either of those ages, 73 or 75. And to be clear, the dollar value, the accounts that they're looking at is all of those pre-tax accounts. So all those funds that you've put into your traditional 401k, traditional IRA, and had those taxes deferred up until this point in time. Those are the accounts that they are looking at when determining what you actually need to pull out for that required minimum distribution. So your Roth IRA dollars, your non-qualified or other after-tax assets are not included in this because the IRS doesn't get any additional tax revenue for you taking withdrawals out of those accounts. And so this is specifically based off of those pre-tax accounts, again, traditional IRA, 401k accounts. Now, there is an exception on the 401k side. If you are still currently employed at that age, say you're 75, you're supposed to start RMDs this year, but you're still employed, still contributing money into your work-based 401k plan, that 401k plan is excluded from the calculation that they're doing on the required minimum distributions. Anything else, so previous employer 401k plans or traditional IRAs, that is what they are looking at for the amount that you have to pull out. Now, the way that this operates is they are looking at the end of year balance as of the previous year. So let's just take 2025 as an example. If you are required to take an RMD this year, that balance that they're looking at to derive the calculation is based off of the December 31st balance of 2024. So sometimes people think, hey, it's as of my birth date or it's as of some other specific date during the year. That's not the case. It's based off of the 12/31 or December 31st balance of the previous year. So the way that this works is they have what's called a uniform lifetime table. It's basically the calculation that they use to be able to determine your RMD amount for the previous year. So kind of just walking through an example here. Let's say that you add up all of your pre-tax accounts, and that dollar value comes out to, let's just say it's $500,000 in this example. So let's say you're required to take RMDs at age 73. They have what's called a life expectancy factor that they look at for the divisor. So at age 73, that number is 26 and a half or 26.5. So they would take that $500,000 pre-tax balance and they would divide that number by 26.5, which comes out to $18,867. And so that dollar figure, that $18,867, is what you are required to withdraw by calendar year end. So keep in mind, this is not tax deadline. It is by calendar year end, by December 31st, out of those IRA accounts. Now, when you do this, that does count as regular taxable income, just like any other time you would pull money out of a traditional IRA. So you'd pull the 18,867 out of it. And then every year thereafter, if you still have money in those pre-tax accounts, in those IRA accounts, you are required to take an RMD amount. So if we kind of future cast this and say let's say you're 80 at that point in time, the divisor, instead of being 26 and a half, is now 20.2. So even if you have about the same amount in there, that percentage is going to go up. So instead of it being about $18,000, it's just shy of $25,000 at that point in time. So again, if you're coming up on that threshold, either 73 or 75, keep in mind that you do have to take that required minimum distribution out. And one of the other common questions that we get on this is, hey, isn't there anything else that I can do with that money besides pulling it out and just paying taxes on it? So people ask, hey, can I do a Roth conversion amount with that? Unfortunately, when you get to RMD age, that is not an option to be able to satisfy that required minimum distribution requirement. So you still are able to do Roth conversions after you turn 73, 75, but you do have to pull the money out and satisfy that RMD requirement first before you can do a Roth conversion on top of that dollar amount. It does not count for that. Now, the one other thing that we'll dive a little bit more into later is charitable donations. So there are options to be able to take that RMD amount and donate it to a specific charity, a 501c3 organization. And that does satisfy the RMD requirement without you having to pay taxes on that distribution, like if you sent that money to your bank account. So we'll circle back on that. But again, just kind of a 30,000 foot view. If you're 73 or 75, you have to take those RMDs. It's based off of the previous year, December 31st balance of that account. And that's divided by that life expectancy factor to arrive at the dollar amount that you have to withdraw there. So anything you'd add to that so far, Brian?
Yeah, there's a right and wrong way to take required minimum distributions. The right way is to include it in the income planning that we actually do. Have it be part of your income. The wrong way is to take income and then have a lump sum at the end to be your RMD, because that's, I don't know, it's an unnecessary taxable gain at year end. And I also want to point out that there's 38 trillion reasons why tax rates probably will go higher. That's about the size of the national debt right now. So how smart are you to minimize your future RMD exposure by doing Roth conversions? And we're going to talk about that. So there should be a way that in your planning, you walk and chew gum, you do two things at once. You pay taxes, and we're going to talk in detail about how to properly do Roth conversions to minimize your required minimum distribution exposure in the future, to pay taxes now on a lower rate than what future probably has in store for us. But those are some important things to also keep in mind with required minimum distributions. Arrin, anything else on that topic before we go on?
The only other thing that I would mention is we want to make sure that you're aware of this and that you actually follow through on it, because if you don't, let's say you just don't do anything and you try to do it, I don't know, during tax time next year or a little bit later, there are penalties for not taking that out. So the IRS does enforce a penalty on that delay or not taking the RMD out, and they still require that you make the withdrawal and pay taxes on it. So sometimes they will give an exemption on that, especially for your first time. But if you're kind of in the road of doing this, you want to make sure to hit those so you're not penalized and you still have to take out that distribution. So that's the last thing that I would add there.
Good, good. Okay, now we're going to spend a lot of time on this. This is very important because the Roth conversion, in my opinion, I think Arrin, you'd agree, is probably the biggest tax saving strategy left for most people in this country. So we're going to spend a lot of time on going through how to properly execute a Roth conversion. So first describe to our radio listeners what it is and why it's so valuable, and then we'll go step by step how to properly do it.
Yeah, absolutely. So Roth conversions, to kind of set the stage here, when you're looking at what are called qualified accounts or retirement type accounts, there's really two main tax types. There's pre-tax, like we talked about with the RMDs, and this is typically going to be your workplace 401k or a traditional IRA. And then there's the post-tax account. And this is, some employers offer a Roth 401k option or your just individual Roth IRA account. So the difference between them is when the taxes are paid. On those pre-tax accounts, money goes into the account before it's been taxed. It grows tax deferred. And then when you make a withdrawal, you pay your regular income tax rates at that point in time. In contrast, Roth IRA accounts, you pay the taxes up front. So the taxes are taken out before the money goes into the Roth IRA account. But once it's in there, it grows tax-free. You can pull income out of it tax-free, and it passes to your beneficiaries tax-free. So there's a lot of advantages once you get the money into the Roth IRA. So there's really two different ways to get money into a Roth. The first is through what are called contributions. And this is the $7,000, $8,000 a year limit that the IRS imposes, where you can just take money that you have and put it into that Roth IRA that you've opened up on your own, or either a Roth 401k. Those same traditional 401k limits apply there as well. The second, and what we're specifically referring to here, is what's called a Roth conversion. And so with the conversions, what you're doing is you're taking money that is already in a pre-tax account, typically a traditional IRA, and you're pulling it out of that traditional IRA, paying the taxes on that amount, again, your regular income tax rates, and moving that money into the post-tax account, that Roth IRA account. So there's a number of reasons why this is typically advantageous to do now versus waiting until RMD age or some other later age to pull the money out of those pre-tax accounts. So the first one Brian already hit on, that right now, from a historical perspective, our federal marginal tax rates are low. If you look at where they have been in the past, and based off of the debt that our country has and some of the other things going on economically, it's very likely that in 5 or 10 or 15 years, tax rates are going to be higher at that point versus the rates we have available today. So if you do Roth conversions today and you lock in the 12, 22, 24% rate that we have now, I view it as a form of insurance against future tax rate increases. So let's say you do conversions up through the 22% bracket, and 10 years from now, that bracket is now the 27 or 28% bracket. You don't have to worry about that tax rate increase because you've already locked in the 22% rate, got the money into the Roth IRA account. You never have to pay federal or state taxes on that money again. So again, it's kind of a form of insurance against those potential tax rate increases down the road.
So if you have questions, so far we've talked required minimum distributions and just got started in the Roth conversion world. Aaron's got more points to make on the Roth conversions. But if you have questions about any of this, you can always talk with Brian, Arrin, the team at Decker Retirement. Just call them. There's no cost. I think it's one of the more important phone calls you will make because we're talking about the next 20, 30 years of your life. 833-707-3030. No cost to you whatsoever. No obligation, no pressure, no judgment either. 833-707-3030. 3030. We're talking about things you need to get done by the end of the year, by the time the calendar turns to 2026, and you're running out of time. 833-707-3030. Brian J. Decker and Arrin Wray back with more right here on Safer Retirement Radio.
The holidays often remind us how expensive life can be. If you're feeling a bit more financially squeezed this season and worry about how you'll fare in retirement, give Brian a call at 833-707-3030. That's 833-707-3030.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. Again, the website, DeckerRetirementPlanning.com. Questions, 833-707-3030. I'm Mark Elliott. Glad you're with us. We're talking about things you need to get done by the end of the year. We're in the final month, and by the time we get to 2026, there are things that you needed to get done, but you have to do them before the end of the year. There are other things you can do next year, obviously, but required minimum distributions have to be done by the end of the year. Roth conversions have to be done by the end of the year if we're trying to get it on this year's taxes. So, Arrin, you were talking about the Roth conversions, and you got through point one. You're ready for point number two.
Yep. So one of the additional advantages of doing Roth conversions is it gives you a lot of flexibility around when you withdraw the money. So we talked a little bit about required minimum distributions, that when you turn either 73 or 75, the IRS mandates that you start taking a specific percentage of those assets out. You have to pay taxes on them. And that amount, that percentage gets bigger as you get older. But with Roth IRA accounts, there are no required minimum distributions. Again, the IRS doesn't care when you pull money out of a Roth IRA. So what typically happens in retirement is that you have multiple sources of income. You're going to have Social Security, you might have rental income, you might have a pension, you might have other things that are providing you with that living expense money. And if you are also forced to take a RMD amount out of those IRA accounts, it's probably going to push you into a higher federal marginal tax bracket. And you have to take those withdrawals. You cannot defer them. But by doing those proactive IRA to Roth conversions, you have the ability to have the flexibility around when you withdraw the money. So if you wanted to pull it out in regular increments, you're welcome to do that. If you want to do kind of irregular lump sum withdrawals based on an as-needed basis, you're welcome to do that. If your goal is more about legacy or inheritance planning, so you're hoping to just get as much as possible built up into those accounts to pass to your kids or other beneficiaries, you have the ability to do that and never take distributions from those accounts. So by having Roth IRA money, it gives you complete control over when you withdraw that money out. You're not forced to take those required minimum distributions. And the last benefit I want to touch on is one that a lot of people don't think about. So many of our listeners from a tax filing status are married filing jointly. At some point in time in the future, one of you is going to pass away, and the surviving spouse is then going to be a single filer, which means that even if you have about the same amount of taxable income coming in, your effective tax rate or your total tax bill is going to dramatically increase because you're now filing as a single individual versus a married filing jointly couple. But again, if you have Roth IRA funds from which to withdraw, you don't have to have a dramatically increased tax burden because pulling money out of the Roth does not increase that tax rate for you. You don't pay taxes, federal or state, on that distribution. So kind of summarizing there, it's complete control and flexibility, locking in those lower tax rates, kind of that form of insurance against future tax rate increases. And it helps mitigate any dramatic tax increase for when one of the two spouses passes away. So, the way that we typically do this here at Decker Retirement Planning is we build out financial plans that illustrate what your income is now and what it's expected to be in the future. And based off of that plan, that income projection, we help you come up with what the best IRA to Roth conversion strategy is going to be. Now, for the high majority of our clients, it is going to be a good idea to do Roth conversions now to be able to get those tax rates locked in, help you front load some of those tax-free dollars now so you'll be able to use them later. And this is something that we help with on a year-over-year basis. So each year, we will look at where you are in those federal taxable brackets, where your income is for the year. And our goal is to make sure that you either stay within that same bracket or convert up through the next one if it makes sense, and essentially chip away at that IRA balance year over year, where we may do a specific amount year over year, depending upon your taxable income for that year, and try to reduce that pre-tax IRA balance year over year to help with those RMDs and that tax-free growth from those Roth IRA dollars moving forward. So it's one of those things where I feel like the general rhetoric in the financial industry is defer, 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 right? The longer you can kick the tax can down the road, the better. But there has to come a point in time when the taxes are paid, right? Whether that's through you as the individual account owner or through your beneficiaries as they receive those funds. And so rather than just sticking your head in the sand and hoping for the best, you want to make sure that you're looking at this from a proactive standpoint, making sure you're taking those steps now, those proactive tax moves now to benefit both you and your eventual beneficiaries for those funds. And as Mark mentioned, the deadline for doing Roth conversions is calendar year end. So a lot of people confuse this because the deadline for contributions, putting new money, those $7,000 or $8,000 limits into the Roth IRA, is tax deadline. So up through April of the next year. Roth conversions, moving the money from the IRA to the Roth account, is based off of calendar year end. And for a lot of these major brokerage firms, whether it's Fidelity or Schwab or Merrill Lynch or whoever it is you're working with, they tend to get backed up towards the end of the year. So if you're trying to cut this close and submit your Roth conversion form on December 27th, you're probably going to be in for a shock when that doesn't get processed until 2026 and counts for that calendar year. So typically, we recommend trying to make sure that the paperwork for this stuff is submitted by mid-December at the latest, just to make sure that you can get through that processing queue of whoever your brokerage firm is, get those things taken care of before that calendar year end there. So, Brian, what would you add to that?
I want to give a side-by-side of a Roth or a no Roth of a 60-year-old growing $1 million IRA at 6% a year. At age 73, he dutifully pays his required minimum distributions. We killed him off at age 90. How much tax did he pay? Well, in his life, he paid $676,732.22. But wait, there's more, because according to the Secure Act, your beneficiaries have 10 years to pay the rest of the tax on that IRA, which is another $718,496.14. Total taxes paid on $1 million IRA growing at 6% a year for 30 years is almost 1.4 million. It's 1,395,228.36. Now, here's what's galling, Mark and Aaron. This transfer to the heirs net of tax is a measly 1.2 million, 1,223,385 after 30 years of growing at 6%, $1 million IRA, the net transfer is only 1.2. So in contrast, what we'd like to do, and let me use a silly analogy. If a farmer, if you have a choice between paying taxes on the weight of the seed or the weight of the corn, you take the seed every time because all that growth is tax-free. That's kind of what we're doing here. So here in same 60-year-old $1 million IRA growing at 6% a year, but this time we do Roth conversions. So pretty aggressive up front, do 225, 225, 225, and then 50,000 a year so that at age 73, required minimum distributions, there are none because everything has been moved over to the Roth by then. We killed him off at age 90. How much tax did he pay? Did he pay $1,395,000? No, he paid a total of $319,474, a savings of almost $1.1 million. Did he transfer $1.2 million to his heirs? No, he transferred 4.1, $4,151,932. This is powerful. It is easily the largest tax saving strategy available to people that's still left. But there's a right and wrong way to do it. So, Arrin, you talked about a lot of the details. You talked about some of the things to watch out for. Now, according to the big, beautiful bill that was passed, we've got to take into consideration IRMA and the new credits that come that are phased out between $150,000 and $250,000. Arrin, you want to cover those items too and how we carefully look to either preserve those or just ignore those?
So the points that Brian was referring to is there's a lot of different factors that we have to take into consideration when looking at what the best Roth conversion strategy for a specific client is going to be. So some of those things can include taxable income now versus taxable income later, the total dollar amount of IRA funds that you have to convert, whether it's $100,000 or $1 million or whatever it is, where you're at in those federal taxable brackets, what it's going to be from an impact to your Medicare, the short window that we have for some of those additional deductions that were put into place from the tax bill over the summer, and combining all of that stuff together to make the best strategy for you.
So Brian and Arrin are talking about year-end tax execution, things that need to be done before the 31st, and actually it means before Christmas, because not much happens in that final week of the year. So you need to get all this in beforehand. Brian and Arrin got a lot more to get to. Stay with us. This is Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. But, of course, you can always call them if you have questions, 833-707-3030, 833-707-3030. Back with more right after this.
Just like the twinkling lights of Christmas, retirement can be a bright and beautiful time in your life. If you've been dreaming of a retirement filled with adventures, call Brian at 833-707-3030 to help ensure your dreams come true this holiday season.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. I'm Mark Elliott. Again, the website, deckerretirementplanning.com. And again, under the heading of Safer Retirement Education, there are 12 different things you can download. There's a checklist challenge, a sample income plan, 3 principles of retirement book, Brian's book, the Decker approach. All of those are 4 of the 12 things you can download. Just do it by going to the website, deckerretirementplanning.com, under the heading of Safer Retirement Education. All that's there for your information. Then if you get some of that and you got some more questions, 833-707-3030 to have a conversation with one of the advisors at Decker Retirement, 833-707-3030. Brian and Arrin today talking about year-end tax execution, and you're going to talk about some of the challenges of Roth conversions. Now, one thing we should say, Arrin, is that Roth conversions could be one of the most, as Brian was saying, one of the most beneficial things you can do for down the road RMD time taxes, but they're not right for everyone, are they?
Correct. Yep. Yeah. I've had people come into my office where their current level of taxable income is in a much higher federal marginal bracket than they're projected to have in retirement. So let's say you're making $500,000, $600,000, $700,000 a year in income now, and your income in retirement is projected to be, say, $250,000, $300,000. So with that higher level of income, 5, 6, 7, you're going to be in the 32, 35% federal marginal bracket. At $250,000, $300,000, you're going to be down in the 22, 24% bracket. So for those people that have a much higher taxable income now versus what the retirement income is projected to be, it may not make sense to do Roth conversion. Now, again, there's always exceptions, but the goal really is for the money you have in those pre-tax accounts, those IRA accounts, the goal is to pay the taxes on that money when it's going to be the lowest. So that's really what we look at there. Now, circling back on some of those other items that we take into consideration, the first thing that we're going to look at, especially for those that are nearing or at Medicare age 65, is what the impact of a Roth conversion will be on your Medicare premiums. Because how much you pay specifically for Part B of Medicare is directly determined by what's called your modified adjusted gross income. So the way that they do this is a little funky. They look 2 years back at what your taxable income was, what your modified adjusted gross income was then, to determine what monthly premium you will pay in 2025. So what people are paying this year in 25 is based off the 2023 modified adjusted gross income. So for the very bottom bracket, married filing jointly couple, if your taxable income was $212,000 or less, your monthly premium for Medicare was $185 per person per month. In between 212 and 266, it jumps to 259, and there are also thresholds above that. So those limits, the thresholds or brackets that they give for Medicare do not line up with the federal marginal tax brackets. They are different. And so one of the things that we will look at is, where is the limit from a federal tax bracket standpoint for your conversion? And does that line up well with what your Medicare premiums are going to be? Now, there are certain times where it does make sense to pay a higher Medicare premium for the advantage of doing the Roth conversion, where we're not going to let that $100 or $200 a month wag the tax tail. And so there are certain times where we, with eyes wide open, know that doing the conversion is going to give you a higher Medicare premium to make sure that we can get that conversion amount done for what makes the most sense there. There are other times where we specifically make sure that the conversion is under what the Medicare threshold is going to be so that you don't have an increased Medicare premium. And that also lines up with the specific Roth conversion number that we're looking at. So again, that's very, very case dependent, making sure that we include that in there. The other thing that Brian briefly mentioned was the new tax deduction that was put into place by the bill that got passed over the summer. So most of you will be familiar with the current standard deductions, which are $31,500 for a married couple, $15,750 for an individual. There was already a small additional tax write-off or deduction for those that were 65 or older. Based off of the new bill that got passed over the summer, there is an additional $6,000 per person deduction that you can add on top of those others. Now, one of the neat things about this is it is not something that you have to take the standard deduction to get. If you itemize your deductions, you are still eligible for that extra $6,000 per person, so $12,000 for a married couple on top of your itemized or your standard deduction. Now, there are income phase outs for this. So for an individual, that income phase out starts at $75,000 and phases up through $175,000, where if you're over $175,000, you are no longer eligible for any portion of that $6,000 deduction. For a married couple, that income phase out starts at $150,000 and runs up through $250,000. So if you're in between there, say you're a married couple and you make $200,000 a year, so you're $50,000 over, the way that that works is for every dollar your modified adjusted gross income exceeds that threshold, the deduction is 6 cents per dollar. So just know that if you're in between there, not the end of the world, it's not a cliff cutoff. You will still be eligible for a portion of that. But again, taking into consideration your specific Roth conversion strategy, we want to see if it makes sense to reduce the Roth conversions a little bit to take advantage of those additional deductions. And again, that does have a short time window. So as of current law, that extra $6,000 per person deduction is set to sunset at the end of 2028, at the end of the current presidential term. There is a possibility that they extend that out, but that isn't guaranteed. So it's kind of a short window we want to make sure we're working within to take as much advantage of that as possible for those Roth conversions. So again, there's a lot of different things that we here at Decker Retirement Planning look at when determining what the best or the optimal Roth conversion strategy for you is going to be. And like Brian mentioned, this is very likely to be the largest tax saving strategy available to you. So you want to make sure to not only take advantage of this, but do so in a way that's going to give you the best bang for your buck there. So anything I missed on that, Brian?
No, we've taken a lot of time on this required minimum distributions and Roth conversions because those are so important, particularly the Roth conversion to do correctly. Let's jump into another one. This is a biggie, year-end tax loss selling, tax loss harvesting. So why don't you cover that, Arrin? And if someone has a non-qualified account and this is new information, this would be a major faux pas for an advisor to not provide this service for their clients. This is very important.
Yep. So tax loss harvesting is specific to what are called non-qualified accounts. So this will not be applicable to your 401ks, IRAs, Roth IRAs. You are not subject to long or short-term capital gains taxes within those retirement or qualified accounts. So this is specific to after-tax money that you've invested in just a traditional or a joint brokerage account. So let's say that you've got a bunch of money in some ETFs, you've held those for a while, and you have some losses in this year. So I would be surprised if you did this year in 2025, but maybe you do. So with those individual positions or with the ETFs, whatever that equity position is that you're holding, the goal of tax loss harvesting is to be able to handle the taxes for that account as efficiently as possible. So what most people do is they will just hold whatever the position is, the ETF, the stock, whatever, until the point in time when they're ready to sell it, either because they want to buy something else or they're looking to actually move that money, actually go spend or use it in some other way. That is a very tax inefficient way to handle that investment. The better way to approach that same investment holding is through what's called tax loss harvesting. So in a year where you have some losses, let's say you bought some stock for $100,000, it's worth $80,000 now, you would sell that position, lock in that $20,000 loss, and with that loss, you have the ability to use that to offset gains on another position. So let's say you have another stock that you have, I don't know, let's say it's $50,000 of gain on. You sell $20,000 worth of that to get a $20,000 gain. So now you have a $20,000 loss, you have a $20,000 gain. Those, from a tax perspective, cancel each other out. Now, what it does for you on a long-term basis is it increases the cost basis of those specific shares. So instead of buying something at 100 and then waiting till it's 150 and you sell everything, you have sold specific chunks of that over time based off of like what your losses were and how to offset that, so that by the time you actually want to sell the entire position, you have moved up your cost basis to be able to make sure that the end sale is going to be a much lower tax bill. You've kind of handled that along the way to move up the cost basis and make sure that you're doing that as tax efficiently as possible. The one other thing that's really helpful on this side is actually what's called tax gain harvesting. So everybody's thinking about losses to be able to offset some of the gains that they have. But for those of you that are down in some of the lower tax brackets, especially the 0% federal capital gains, the long-term capital gains bracket, you actually have the ability to sell off some of those long-term capital gains eligible holdings within that limit. This year, for a married filing jointly couple, it's about $97,000, and pay 0% in long-term federal capital gains taxes. So there's both tax loss harvesting and tax gain harvesting. Again, making sure that over those years that you have those funds invested, you have the ability to manage those things as tax efficiently as possible versus just indefinitely holding and selling the whole thing at some point in time in the future.
let's say I use Google and have a huge gain in Google and I've got losses in an oil stock. I could sell the oil stock, apply the losses to Google. Let's say I have 30,000 in losses in Google. I would buy OIL for 31 days as a substitute for my oil stock because that would be the ETF. And then I would sell $30,000 worth of Google, buy 30,000 of QQQ as a substitute for 31 days of Google. And then after 31 days, I would switch it back, buy Google back, raise my cost basis, sell the OIL ETF and buy the oil stock back if you wanted. But anyhow, Aaron, you gave a very in-depth description of tax loss harvesting. And if you're not getting this service done for you, that is a major, very important tax saving strategy at year end with a 12/31 deadline that has to be, the sales need to be done by 12/31. Aaron, anything else on that topic?
Nope, I think we're great there.
All right. Well, we're going to come back and wrap up today's show with our final segment coming up next. But if you have questions about any tax loss harvesting, tax gain harvesting, Roth conversions, required minimum distributions, just being in a better tax position moving forward, call the team at Decker Retirement. It's 833-707-3030. Again, no cost to you, no obligation, no pressure, no judgment. 833-707-3030. Might be the most important phone call you make, and it costs you nothing but a little bit of time. 833-707-3030. Back with our final segment of today's Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning in 1 minute.
This holiday season, while you're making your Christmas wish list, don't forget to include your retirement dreams. Give Brian Decker a call at 833-707-3030 to unwrap the perfect retirement plan for the future you're dreaming of.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. I'm Mark Elliott. Again, the website, DeckerRetirementPlanning.com to learn more. DeckerRetirementPlanning.com. I'm Mark Elliott. Glad you're with us. We're talking year-end tax execution. We covered a lot of ground today. And now, Brian, I think you and Arrin are going to get into some charitable distributions or something like that, donor advised funds, all that stuff that I don't understand.
Yep. QCDs, qualified charitable distributions. Aaron, what are they? How are they used by year end?
Yep. So qualified charitable distributions are a way to give money directly from your pre-tax IRA accounts to a qualified charity. So this does have to be a registered 501c3 organization. And this is something that gives you the ability to both benefit the charity that you want the money to go to and reduce your tax bill for those IRA funds. So normally, when you move money out of a traditional IRA, you have to pay your regular income tax rates on that distribution. But the government gives you a special benefit for sending that money to a charity. So let's just say, as an example, you want to move $25,000 to some kind of 501c3 organization, a church, a school, a hospital, whatever it be. You have the ability to move that directly from the IRA account to that charity. Now, what it does is it means that it does not count as taxable income for you. So you don't have to pay income taxes, state or federal, on that. The charity receives the full benefit of it, And for those of you that are at RMD age, it does count as that required minimum distribution. So we have a lot of clients that are at RMD age. They don't really want to pull the money out. They don't need it as income. They don't have a use case for it, but do want to benefit a charity. So they just transfer whatever their RMD amount is in any given year as a qualified charitable distribution, a QCD, to the charity that's close to their heart. And we help them facilitate that process year over year. So the one other piece I want you to be aware of here is that there is a minimum age threshold. You do have to be age 70 and a half or older to take advantage of this. So those of you that are in your late 60s, not quite there yet, but when one of you turns 70 and a half or older, then you have the ability to take advantage of that qualified charitable distribution. So anything else on that before I jump over to some of the other options, Brian?
Nope. Let's quickly go over to donor advised funds.
Okay. So donor advised funds are really useful in a couple different circumstances. The first is if you are looking to get additional tax benefit out of charitable donations that you are already making. So for a lot of people, the charitable donations you make don't exceed the current standard deduction. So for a married couple, again, that's $31,500. Let's say, as an example, you're giving $20,000 a year to charities. Because that level doesn't exceed the current standard deduction, you don't really get an additional tax write-off for making that $20K donation. So what a donor advised fund does is it allows you to be able to set up a specialized charitable account and front load the charitable contributions into that account. So let's just say you put $75,000 into this donor advised fund. You get an itemized deduction in the year the donation is made. So you'd get a $75,000 itemized deduction for tax year 2025 that you can use to write off against your income. And then from that point in time forward, you still have complete control over when and to what charity those assets are distributed. Now, it does have to go to a 501c3 organization, and you could do it as equivalent increments over the course of a number of years. You could kind of do it in irregular intervals. You could hold it in there, grow the funds for a while, and then decide later what charity you want the money to go to. So you have a lot of different ways that you can use it, but that's a great way to be able to get additional taxable advantages out of those charitable donations that you're already making. The other way that this can be used is for spikes in income. So let's say that you have a specific taxable event in one tax year where your income jumps from, I don't know, $200,000 to $500,000, and you're trying to figure out ways to drive down your taxable income into some of those lower federal marginal brackets. You want to get down into the 24 or 22% bracket. So again, by doing a large donation to that donor advised fund, that's going to count as an itemized deduction for you, help you push your taxable income for that year down into those lower federal marginal tax brackets. So that's the donor advised fund there. Anything else you'd add to that one, Brian?
And you would target appreciated stock, right? If you didn't want to pay huge capital gains, is that right?
Yeah, good points here. So to be clear, the money that you're donating to a donor advised fund does have to be non-qualified assets. It cannot be traditional IRA or Roth IRA assets. Has to be those after-tax non-qualified funds. And the best way to do this, the most advantageous way to you, is by donating appreciated equity. So it could be stocks, mutual funds, ETFs, any of those equity positions. But let's say that you bought a specific stock for $50,000. It's now worth $100,000. You're looking for ways to eliminate capital gains as well as make some charitable donations, get those itemized deductions. You could transfer that stock directly from your brokerage account into that donor advised fund. You don't pay capital gains tax on that. You get that full value in the donor advised fund. You get that full $100,000 itemized deduction on your taxes. And then again, you still do control how the funds are invested within that donor advised fund to manage them however you want moving forward. So that's kind of the optimal way to be able to do that. If you have just cash set aside that you want to do it to as well, that's also an option. But if you have highly appreciated stock, that's going to be the best way to be able to take advantage of those various tax advantages there. On the appreciated stock, if you're not wanting to do that into kind of a locked up position in that donor advised fund where those funds have to be donated to charity. You want to just do maybe a smaller portion year over year. You do also have the ability to donate regular non-qualified brokerage shares to a charity as well. So this is specifically for people that are under that 70.5 threshold. Again, you can do that over 70.5, but a lot of people prefer QCDs from IRA accounts at that point. But if you're 65, you want to donate some money to a charity, you have some highly appreciated stock or ETF positions, you do have the ability to donate those stock shares directly to the charity as well. You don't pay capital gains on that transfer. Charity receives the full benefit, and you do also get an itemized deduction for that donation as well.
So, Arrin, what are some of the things that need to be sorted out between the 12/31 year-end deadline and April 15th?
Yeah. So here's a few things that we recommend people do as kind of a yearly check-in. The first is take a look at your 401k plan. I can't tell you how many people I've met with where they say, hey, I set this 401k plan up 15, 20 years ago. I've kind of just let it ride. I have money go in. I'm not really sure how much or where it's headed to. You want to make sure that you have an annual update, at least an annual update, to make sure that that's set up how you need it to be set up. So a couple of things I'd recommend you check on. Number one, what percentage of your funds, of your paycheck is going towards those 401k contributions? And do you have the ability to increase that? If you're not already maxing out that annual limit, do you have the ability to bump that up? Maybe as you get raises every year or have other things, maybe you got your mortgage paid off and you have more discretionary income. Do you have the ability to increase that savings percentage in your 401k? The second thing to look at is my 401k contribution going to the right location? Now, most employers nowadays are going to offer both a pre-tax or a traditional 401k and a post-tax or a Roth option. And does it make sense for you to switch them, right? Should you change from traditional to Roth or the other way around, depending upon your income situation, making sure that those dollars are going into the correct tax type of account. The other thing you want to look at is, do you want to make contributions to either a traditional IRA or a Roth IRA? So again, this is that $7,000 or $8,000 limit, depending upon your age, going into those accounts that are on top of what you can contribute to your workplace 401k account. And again, that's per person. So you can double those amounts to $14,000, $16,000 for a married couple. And that can help just bolster those retirement savings that you have. If you're already maxing out your workplace 401k, you're like, hey, where do I put the extra money? I'm trying to save as much as possible into these tax advantage vehicles. Doing that into the either traditional IRA or Roth IRA, depending upon your income, is also a phenomenal way to be able to build those up. And again, those contribution deadlines are tax deadline. So you can contribute up through April of 2026 for the 2025 tax year. So just kind of do an annual check-in, make sure your money is going where you actually need it to be, both the dollar amount and the specific tax type. Again, doing that annual check-in is going to be really helpful for you when you get 10, 20 years down the road, making sure that you didn't have any past mistakes that you regret at that point.
Okay, here's another little bit of information that's helpful. What to provide your CPA at year end. Personal taxes, make sure you've got your income documents, your W-2s from employers, your 1099s, K-1s, all those. And when it comes to deductions, if you've got the standard deduction, you don't have to worry. But if you're itemizing, make sure you've got your mortgage interest statement, your property tax bills, your charitable donations, your medical expenses, your education expenses, childcare expenses, HSA, FSA, all those will be important for itemization. And then when it comes to investment and retiring, make sure you've got your records for IRA, Roth, 401k contribution records, year-end brokerage statements, gain loss summaries from sale of assets in your non-qualified accounts, 529 contributions for the different kids you got or grandkids. Others would be estimated tax payments made during the year. You've got a record of that. And then when it comes to business owners, corporations, LLCs, partnerships, sole proprietors, make sure you've got your P&L, your balance sheet, your general ledger, your trial balance, your revenue and banking records. Boy, there's a lot here. But for real estate investors, I'll just wrap up. Make sure you've got your rent collected per property, your expenses per property, your mortgage interest and amortization schedule per property, your closing statements, your HUD statements, and any mileage logs for property visits. Mark, how's that?
That was good. And you think about all the ground that Arrin and Brian covered today on Safer Retirement Radio. They do it every week on this program. They give you the opportunity every week to have a conversation with them, though, for the questions that pertain to you, some of the concerns you have, some of the questions you have. All you have to do is give them a call. There's no cost to take advantage of this opportunity, especially if you have year-end concerns. Then now is obviously the time to do it because you can't do it after Christmas. It'll be too late. 833-707-3030, 833-707-3030. I still think it's one of the more important phone calls you're going to make. 833-707-3030. Brian and Arrin, as always, a pleasure. Enjoy the rest of the weekend. We'll do it again next week, Brian.
Thanks, Mark.
Thanks, Mark.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.